Before we can even begin to think about managing financial risks, we need to understand what risk actually is. So what do we mean by the word risk? We often think about probability and chance, as well as failure and loss. These terms make sense if you are considering skydiving out of an aeroplane. However, risk, as per the Australian Risk Standard, can be defined as the effect of uncertainty on objectives. That is, risk is any deviation that may occur from what was expected. In the context of financial risk, we are considering whether changes in financial related items impact the ability of the organisation to achieve its objectives. It is important to note from this definition that the deviation from what is expected can either have positive or negative outcomes. In business and in life, we typically consider risk as only focusing on the negative financial impact, and we try to minimise the damage that can be caused. That is, we typically think of financial risk management as a value protection exercise. However, it is important to consider all financial risks and ascertain whether and how financial impacts can arise. Any decisions we make or activities we undertake to create value will attract a certain amount of risk. There are always variables and uncertainty in our business operations. We therefore need to consider financial risk management as being an inherent part of value creation activities. From here, we note that risk is not always a bad thing. To run successful businesses, we don't always need to eliminate risks. However, we do need to identify risks, understand how they may impact our business, and then manage those risks such that we can have the greatest chance of achieving our business objectives. So let's turn our attention to financial risks. There are 7 categories that we use to classify and analyse financial risks. Think about a small company that manufactures windows for houses and has received a large order from a customer. And to fulfil this order, they enter into purchase contracts with suppliers for very large quantities of glass and aluminium. The company has incurred an upfront liability that will actually fall due before the customer receives its order and pays. Therefore, the company has a risk exposure related to having sufficient cash to pay the supplier invoices when they are due. This risk exposure is greater if existing assets cannot be sold quickly for cash without significantly reducing the price received. This is liquidity risk and relates to having enough liquid assets, that is cash, to be able to make any payments that are required on financial commitments when they are due. If we think about what can happen if a company has expansion plans and requires funding from external parties, or where the company has started its expansion already and has some long-term debt in place which is coming up to maturity. In both cases, the company needs to access funding either through borrowings from lenders, whether new debt or rolling over existing debt, or equity from shareholders. What might the risk be in this case? This happened to Centro Property Group in Australia in 2007 as it became wrapped up in the global financial crisis. Centro had expanded at an incredibly rapid pace and as such was really highly geared. Therefore, when funding from banks and large investors became harder to access, Centro was unable to access additional funding and roll over its long-term debt. The end result was its stock price crashed and a major restructure and asset sales took place. This is funding risk. Will you have access to funding as and when you need it? Consider the situation where a company borrows money from a bank to expand its operations and purchase a new factory. There are risks associated with changes in the interest rate. So if the loan is a variable rate loan, what might you be exposed to? Or if the loan is a fixed rate loan, do you still have a risk exposure? Conversely, consider the situation where a company lends or invests money. These risks associated with variations in interest rates also apply. These are examples of interest rate risk. With floating or variable rates, changes in interest rates can lead to higher or lower interest amounts. Even with fixed rate loans and investments, the fair value of the instrument can actually fluctuate if interest rates change.